This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Ever since the start of our studies in IHT, we have seen that IHT is very different in terms of its computational base as compared to any other tax that we've looked at. This, we have kept on saying, is a cumulative donor-based tax. So although tax may become payable by donees in relation to, for example, lifetime transfers, although the tax becomes payable by the donees, the amount of tax that is payable is nothing to do with the donee. It's everything to do with the donor and the availability of that particular transfer to the nil rate band. And what we've seen is that we use, as stated here in the last computational bit of this chapter that we have to deal with, is this 7-year accumulation period. That in lifetime, the only tax that may become payable is on CLTs. Those are the lifetime transfers chargeable when made. But you can't just look at one CLT in isolation. In knowing about how to tax the current CLT, we need to know whether any or all of the available nil rate band of this tax year is still available. Or has it been used up in full or in part on transfers made within the previous 7 years. We work on like a 7-year rolling cycle as regards the availability of a nil rate band. In terms of the tax on death, we can't look at an individual pet, let alone a CLT, in glorious isolation and say, oh yeah, the tax on that £200,000 transfer is this amount. The tax on a 200,000 chargeable transfer could be nothing if it was all falling within the nil rate band. It could be 40% tax on 200, £80,000 tax if it was all in excess of the available nil rate band, or part of it could be at nil, part of it could be at 40%. So you could have 3 lots of £200,000 transfers, as we played with in our early studies, our early sessions together here, and come out with on those 3 self-same transfers in terms of what went to the beneficiary, very, very different figures of tax. Anything between 0 and £80,000 worth of tax might have been payable. And it's all down to this 7-year accumulation period. So to remind you what I said at the end of the previous session, but just to make sure there are no doubts about this now. In the illustrations so far, apart from illustration 8, all the lifetime transfers, both pets and CLTs, they've all taken place within the 7 years prior to death. And again, it's very possible, if not probable, that your exam question will do that as well. And what that has meant is that they've all been chargeable to IHT on the death of the taxpayer. Obviously, if there was a CLT, it would also have faced chargeability when made in lifetime. But on death, how do we then tax those pets and CLTs falling within the 7 years before the date of death? The earliest, i.e. the oldest transfer within that 7-year period, are deemed to firstly use the nil rate band. With the later transfers, and if there aren't any of the chargeable estate, then being taxed at 40%, as soon as you've used up that 325,000 nil rate band. I say 325, of course, we know it could be up to double that if you have the unused nil rate band of a previously deceased spouse to be able to access. Up to 100%, of course, could be the unused nil rate band proportion, so you could get up to £650,000 of nil rate band. But other than that, your individual nil rate band is 325. Now then, if pets have been made more than 7 years before the date of death, then they were not chargeable when made, nor were they chargeable on death. And we saw that with illustration 8. So they were exempt IHT and were ignored when looking at the 7-year accumulation period used to compute the IHT on transfers that do fall within the 7 years of death. So therefore, if you had a pet 8 years before the date of death and a pet 6 years before the date of death, the pet 8 years before death is not chargeable on death, nor does it affect any taxability of the transfer made 6 years before the date of death, a transfer which is chargeable because it does fall within the 7 years before the date of death. We could simply ignore the amount of that chargeable transfer on the 8-year-old pet there. In calculating, of course, the chargeable transfer, the pet of 8 years ago, even though it will not now become chargeable, do remember that it would have used up any annual exemptions at the time. Now, that's only going to be an issue, as we'll see in our example coming up. It's only going to be an issue if we have a pet that, although more than 7 years before the date of death, lies within the tax year of, or the tax year before, a CLT that also falls more than 7 years from the date of death, but is not now going to be ignored. This is the most difficult concept to grasp, so I'll warn you here. Once we've cracked it, it's just a very mechanical exercise, but again, getting our head around it, of anything in IHT, it's usually the bit that causes most students to do a bit of head scratching, but hopefully we'll crack it first time. How to deal with a CLT made more than 7 years before the date of death. These transfers, as we know, were chargeable when made using the nil rate band in force at that date, but then are not chargeable on death as the taxpayer has survived for the required 7 years. So they were chargeable when made, not chargeable on death. So all that is chargeable on death is the transfers that occurred within the 7 years before death. But in taxing any one of those transfers, you need to know what amount, if any, of the nil rate band is still available. And that was by using this 7-year cumulation period. So it means that when computing the IHT on either a PET or a CLT made within the 7 years of death, if it's within the 7 years of death, like in the previous example 1, it becomes chargeable on death. But now, when computing either a PET or CLT made within the 7 years of death, it is necessary to take account of any CLTs made within the 7 years prior to it. Why do we need to do that? Not that they will become chargeable, as they fall outside of the 7 years before the date of death, but so as to determine how much nil rate band, if any, remains to use against that transfer. Right, there's been a lot of words there and a lot of inside 7 years, outside 7 years, before death, whatever. So a little example to try to put this into place. So an individual dies in January 2018, having made a CLT in June 2008. Very clearly, more than 7 years before the date of death. But because it was a CLT, the CLT will not be taxable on death as he survived for more than 7 years, but would, of course, have been chargeable in lifetime. If it was a PET made in June 2008, other than it would have used up any annual exemptions available to it, it does not then become, well, it was not then chargeable when made, and it is not chargeable on death. So we can ignore the amount of any chargeable transfer. But a CLT was chargeable when made. If it was made in June 2008, we'd look at the nil rate band available in June 2008 and calculate the amount of lifetime tax. We then establish for it, whether it was a net or gross transfer, what the gross amount of that chargeable transfer was. But our hero has lived till January 18, so the June 08 CLT will not be taxable on the death as he survived more than 7 years. If he'd also made a PET in August 13, then that PET will be taxable. Died January 18, PET August 13, the PET will be taxable, because that's within 7 years of the date of death, as per normal. So we need to know, when taxing that PET, what nil rate band, if any, would be available. Now, what you cannot do here is simply look at if the PET is the only transfer made in the 7 years before the date of death, there in August 13. You cannot say, so that means I've got all of the nil rate band available to go against this PET. Sadly not, because the CLT That was made in June 2008. That is within 7 years of the August 13 PET that is now taxable on death. But this June 08 value will be deemed to have used up that amount of the available nil rate band that would otherwise have been applied against the PET. Now what's that going to do? It means it could push some, if not all, of that August 13 PET out of the nil rate band and up into the 40% band. So in computing the nil rate band available to go against the PET, the 325 will be reduced by the amount of the June 08 CLT as it had been made within the 7 years prior to the PET. So it goes back to what we've always said. IHT is a cumulative donor-based tax. When taxing any individual lifetime transfer, you cannot tax in glorious isolation. You need to have gone on. You need to know, rather, what has gone on within the 7 years before it. And if the 7 years before it take you back more than 7 years before the date of death, though back then we can and will ignore PETs in terms of the use of the nil rate band, we cannot and must not ignore CLTs because they will be deemed to have used up that amount of the available nil rate band at the date of death. Right, let's see whether or not we can put that into practice with example 2. Our requirements to calculate the IHT payable on the lifetime gifts when they were made, CLTs, assuming that D paid any lifetime tax due. So that means we're talking about CLTs and that they will be net transfers. Net transfers means anything above the available nil rate band for the tax year in which the CLT was made. Anything above the then nil rate band would be charged at 25%. And to calculate the IHT payable as a result of D's death. That means, of course, any lifetime transfers made within the 7 years of the date of death become chargeable, as well as the chargeable estate. We can also see that some other nil rate bands have been provided to us here for years when we may have had other transfers that took place. Let's have a little look at what we've got. Our again humorously entitled taxpayer, deceased, died on the 1st of March 18, with a chargeable estate of £500,000, having made the following lifetime gifts. Just on that chargeable estate of 500,000, it's just a grand total. There is no mention in there of there being a main residence of D within that chargeable estate. And if you are to use the residence nil rate band, you will be told about the existence of a main residence. So that is telling you by exclusion that there is no residence nil rate band to apply in taxing the chargeable estate. So always check that out. Do we have a main residence? Will there be a residence nil rate band in taxing the chargeable estate at death? Right. So calculate the IHT payable on the lifetime gifts when they were made. So that means that there must be a CLT. But what have we got? 1st of October 06, £100,000 cash to son. That is a PET. It was not chargeable when made. It is not within, very clearly, nowhere near within the 7 years of the date of death. It will not be chargeable on death. So not chargeable when made, not chargeable on death, and because it was a PET and not chargeable on either occasion, in lifetime or on death, it will not have any impact on the death of the taxpayer for any transfers that do fall within the 7 years of the date of death and therefore do become taxable. It will not be deemed to have used any of the available nil rate band. Then the 1st of June 07. Cash into a trust. That is a CLT. That therefore is both chargeable when made to begin with. It would be chargeable on death if you died within 7 years, but again look at the date, June 07, March 18, lived for more than 7 years. So it'll be chargeable when made, it will not be chargeable on death. But when you do calculate the tax on the transfers that do fall within the 7 years of the date of death, that'll be this transfer here, the 1st of September 12, the 296,000 cash to the daughter, that in determining what nil rate band is available, because September 12 is within 7 years of June 07, we're going to have to deal with the fact that some of that nil rate band will be deemed to have been used by the earlier CLT. But that's for later. That's when we calculate the IHT payable as a result of D's death. But at this point, when it was made, June 07, it's a CLT. That's the transfer of value. Would there have been any deductions from that? Well, yeah, if there were any annual exemptions. June 07, that is in the 07-08 tax year. There was a PET that predated it, October 06. That is in the 06-07 tax year. So the CLT will have available the annual exemption for 07-08, the current tax year. But it will not have available to deduct in computing the chargeable transfer the previous year's 06-07 annual exemption, because even though that PET wasn't chargeable when made, does not become chargeable on death, you still apply annual exemptions on a strict chronological basis. So the only annual exemption to put against the June 07 CLT is the 07-08 annual exemption. We move on to September 12, cash to daughter, that is a PET. When dealing, of course, with the PET, we need to know what, again, deductions are available against that. Well, it was made in September 12, and the prior date to that was June 07, so we would have available which annual exemptions, I think, again, very obviously, 12-13, and that of the previous year, the 11-12 tax year, because that has not been used. So we've got 12-13 and 11-12, two lots of £3,000. Right, nil rate bands given here. We don't need the 06-07 because that's when the PET occurred. It was not chargeable when made. The CLT, however, was made in 07-08, so that is relevant to us. 11-12, well, actually, sorry, that's wrong. It should have been, it's irrelevant anyway, but it would have been the 12-13. They're tempting you there to think that when you tax a PET, you maybe use the nil rate band in force at the date. You do not. PETs only become chargeable on death, and on death you use the nil rate band in force at the date of death, which of course, as you're expected to know, is always the £325,000 figure that we've had for many, many years now. All right, so what I want you to do, therefore, is for these two transfers that will create chargeability, either in lifetime or on death, you need to do your chargeable transfer working. So the first one is labelled CLT, dated June 07, and the second one, September 12, is a PET. You need to work from the transfers of value as given there, 311 and 296, take out the relevant annual exemptions, and derive, please, the chargeable transfer figures. Because one of those chargeable transfer figures is then a CLT, that means you need to compute the computation headed lifetime transfers chargeable when made, which is exactly what we did in the previous example 1, but when computing that tax, looking down here, we can see that at the time it was made, the nil rate band was £300,000. But everything else is exactly the same there. Again, D paid any lifetime tax, that made it a net transfer, so anything above the then nil rate band will be taxed at 25%. Right, I'd like you to do the working for chargeable transfers, and I'd like you to do the computation for lifetime transfers chargeable when made, please. And then again, rejoin us to work through the answers to that. Okay, let's see how we've fared, therefore, in the first two of the 4 steps that, of course, are required when dealing with a computation and exercise of this nature. First of all, computing the chargeable transfers. Now, just have a little read through here. They are the things that we have already said, but let's make sure that we pick them up, allowing us to then do this working for the chargeable transfers. The gift, as we know, on the 1st of October 06 to her son, we labelled as a pet. Wasn't chargeable when made, nor will it be chargeable on death, because D survived for the required 7 years. The transfer is therefore exempt, but will be deemed to have used the annual exemptions for the relevant tax years, current year 06-07, which is the critical one, and the previous year 05-06. Now again, there's no need for you to be writing any of this down, probably going to be an OT question anyway, but the relevance of that, of course, is that we've used the 06-07 annual exemption. The gift on the 1st of June 07 is a CLT, chargeable when made, but not on death, as D again survived for the requisite 7 years from that date. The gift on the 1st of September 12 is a pet. It will only be chargeable on death, as D died within the next 7 years. Chargeable transfers, the transfer of value, just the given figures, 311,296. Are annual exemptions, firstly against the CLT. Purely 07-08. The 06-07 is deemed to have been applied there against the earlier pet. But now for 07-08 we have the CLT, 1 annual exemption. Again, as we wrote on our question page, for the pet, the 12-13 annual exemption and the 11-12 annual exemption, both available in full. So there we go. We've got a chargeable transfer, a CLT made in lifetime, 308, and the pet chargeable transfer, 290. Okay, do we have a CLT? Yes, we do. So on to step 2. Lifetime transfers chargeable when made. Pick up the chargeable transfer figure, put it in your working column. There it is, June 07 CLT. What was the then nil rate band we were told? It was 300,000. 308 goes above that. So the first 300,000 at nil, leaving 8,000 above the available nil rate band that now therefore gets taxed at the relevant lifetime rate. D, the donor, is paying the tax. Therefore, it is going to be a net transfer. Therefore, we use the 25% rate. 8,000 at 25% is 2,000. Put your tax figure in. The 308 was a net transfer. On top of that, what does the donor, D, also have to pay out? 2,000. So the gross amount of the transfer, £310,000. Now, of course, in real life, all of this will have happened years ago, and we'd have reference back to it to now allow us to deal with, sadly, the rather more recent death of the taxpayer and the lifetime transfers chargeable on death. Now, this, as we say here in this introduction, is potentially the hardest part of the question and requires us to firstly determine the earliest transfer within the 7 years before death as the starting point. Now, there is only one transfer made within the 7 years before the death, and that was the pet, for which we had a chargeable transfer of 290. And if, of course, nothing had ever happened before that date, or only pets had been made before that date, then none of that would be relevant on death, and that 290,000 would be fully taxed at the nil rate band. It would be all within the nil rate band. But this is where the plot thickens in terms of the problem. As we know, there's only one such transfer, the pet, that is chargeable, but in computing any IHT payable on this transfer, we must take account of what nil rate band is available after firstly deducting from it any CLTs made within the 7 years of this transfer. And we know that within the 7 years of that pet, dated September 12, that would take you potentially as far back as September 05. Well, June 07, there was the CLT. Only because it is a CLT is it now deemed to have used an amount of the nil rate band. So, how do we then do this computation? The lifetime transfers chargeable on death. 2 columns, gross transfers and tax. What we then do, leave a space of a few lines and write in the first transfer that arose within the 7 years before the date of death. Pardon me. Let me just have a slurp of water here. My pardon to you. Hopefully you got nice gurgling sounds there as the water went down the throat. What we've got the first and only transfer made in lifetime, dated 1st of September 12. Because it's within the 7 years of the date of death, it becomes chargeable. But we need to know what the nil rate band available at this date was. And for that purpose, we show before it any CLTs made within the 7 years of that date. That date is the 1st of September 12. In the 7 years before it, we had this, the CLT, with a gross transfer of 310. So that is effectively the cumulative total that existed at the time this PET was made. Now you can see what difference this makes. Instead of having 325,000 nil rate band to go against that 290, and therefore there'd be no tax payable on that PET whatsoever, we've now deemed to have used 310, the amount of that earlier CLT, which leaves only 15,000 at nil, pushing out of this 290, 275,000 up into the 40% band, meaning that there's a tax charge of £110,000 there. Now, of course, it's not going to be that bad because not all of that 110 will be chargeable, because this date, as compared to the date of death of the taxpayer, is more than 3 years from the date of death. So we get taper relief. Now again, I'd like you to look back through what we've just said, have a think about what I've said. You can see the taper relief there, but you work that out for yourself and make sure that you are certain about why that is the amount of tax to pay in relation to the PET. Get used to using these CLTs that, although more than 7 years before death, fall within the 7 years of a transfer or transfers that do fall within the 7 years before the date of death. And it is the taxability of them, here the September 12 PET, that is impacted so much by the existence of that earlier CLT. Right. Again, I'll just pause at this point. You check through, have a little read of the note that follows, and then we'll deal finally with the chargeable estate at death. Okay, to recap therefore, the impact of that earlier CLT there made back in, what was it, 2007, June 07. Although that CLT of the 1st of June 07 has drastically affected the tax payable on the PET, that of the 1st of September 12, it will only be relevant for transfers that are then within the following 7 years. Hence, any transfer after that date, 7 years on from the 1st of June 07, the 1st of June 14. So, this CLT only has an impact, a cumulative impact, on later transfers that are chargeable, that do fall within the 7 years before the date of death, that fall prior to the 1st of June 14. Because after 7 years, the CLT ceases to have any cumulative effect. It's their 7-year accumulation period. Now here, there weren't any PETs or further CLTs made after the 1st of June 14. So what it means is, it's by the time we tax not now another lifetime transfer, but the chargeable estate, that will not take account of the earlier CLT. We're only going to tax the chargeable estate by reference to what happened in the 7 years before the date of death. And that therefore means it will only pick up, will only consider the PET of the 1st of September 12 in determining the available nil rate band at the date of death. So what have we got? Chargeable estate at death, dated 1st of March 18, We've got a chargeable estate of 500,000. Remember, if there's no reference to a main residence, there is no main residence, therefore there is no residence nil rate band. So what do we have as an available nil rate band? Well, now looking back over the 7 years before death, we had a pet becoming chargeable of 290. So it's only 290 of the available nil rate band at the date of death of 325 that is deemed to be used, leaving not a lot, but at least £35,000 of nil rate band to go against the death estate. 35,000 out of the 500, leaving 465,000 to be taxed at 40%, and hence we compute the tax payable on death. Okay, now I'd like you therefore to work back through that exercise, and again there's further exercises for you to do in the practice examples. I will sort of call it a halt at this point. There is a further little narrative issue to talk about tax planning when it comes to IHT. I'll actually reserve that for a next and very short, I hope, final session with you. But make sure you can do these number crunches, make sure you've got these techniques sorted by then.